Welcome to the Tech Index AI podcast, where we blend tech IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo. So today, we're doing a deep dive into the latest Tech Index air freight data. We really want to understand, how the big macro signals are playing out. Things like fuel costs, trade policies. How are they actually shaping logistics right now?
Yeah, absolutely. And if you just glance at the main global index, the Baltic Air Freight Index, BAI 000, well, on the surface, it looks incredibly calm. I mean, rates were basically unchanged last week. A tiny, tiny fall, minus 0.0% week on week. Looks like stability, right?
Okay, but 0% change. That hides a lot, doesn't it? Because you've got to look at the year-over-year number, and that's still way down.
Exactly. That's the crucial context. It's still down significantly, minus 8.1% compared to this time last year. That's quite a drop.
Right, so that minus 8.1%, that's not really stability, is it? It feels more like things have settled at a much lower level after, well, the big drop we saw over the last year. And how can we even call it stable when the regional picture seems so all over the place?
That's where it gets really interesting because, yeah, there's massive divergence. You've got Asia firming up quite noticeably. Rates out of China were up, mostly that pre-Golden Week rush, which, we kind of expect. Hong Kong, that's the BAI 30 index, was up 2.2% week on week. And Shanghai, BAI 80, also up 1%. And we saw firmer prices from places like Vietnam and Seoul, too, especially heading towards Europe.
Okay, so Asia's pushing upwards, driven by that holiday effect, but that's completely canceled out, globally speaking, because things in the West look, well, weaker.
Pretty much balanced out, yeah. We saw some significant softening in Europe. Frankfurt dropped 6.5% week on week. London Heathrow was down about 2.5%, and Chicago also saw a pretty big dip, down 7.7%.
Wow, okay. But hang on, what about the transatlantic lanes? Those seem to be doing their own thing entirely. Rates into the U.S. are flat week on week, you're saying? And U.S. to Europe, rates are actually higher year over year. That feels backward compared to everything else.
It is, yeah. It's a key anomaly. It's likely still driven by pretty steady demand for certain high-value U.S. exports, things that need to get there fast.
Yeah.
But, okay, we've looked at the price signals. Let's talk about what's actually powering the planes, fuel costs.
Right, because that's been a big story. Oil prices, Brent and WTI, they've slumped to, what, a 16-week low? Classic macro stuff happening there, that bigger than expected rise in U.S. crude stocks, plus all the economic jitters around the U.S. government shutdown, potentially.
Exactly. And that slump in crude oil translates pretty directly into, well, potentially huge relief for airlines on the cost side. We're seeing U.S. gasoline futures at their lowest in almost a year. So, that suggests potential relief on jet fuel costs, too. Even if the freight rates themselves look flat right now, chopping a big chunk off your main input cost, that changes the whole operating picture for carriers, gives them more breathing room on margins.
Okay, so we've got potentially cheaper fuel easing cost pressure, but then you layer the trade situation on top, and that's still pretty messy. The global manufacturing picture seems really mixed. Asia's factory activity apparently contracted in September, while the U.S. is only just sort of edging towards recovery. And tariffs are still a huge factor.
Oh, absolutely. Tariffs on major trade routes are still seriously high. China's around 30%, India at 50%, the EU at 15%. That makes long-term planning incredibly difficult. And these duties, they often get passed straight on to consumers, right? Which then affects demand, especially for those higher-value goods that tend to travel by air. The real issue here is just the sheer instability and uncertainty it creates.
Yeah, it's weird, though, isn't it? Because you mentioned the shutdown worries, maybe weak jobs data, but Wall Street indexes actually closed higher. Markets seem strangely okay with political drama sometimes.
Well, historically, markets often shrug off short-term government closures. They seem much more sensitive to fundamental shifts in trade policy and tariffs. That's the paradox.
So let's try and boil this down. For you, the listener, maybe working in logistics, what's the takeaway? It feels like global air cargo pricing is kind of treading water overall right now.
A holding pattern.
But that global calm is really masking some dramatic regional shifts, Asia up, West down, and this underlying downward pull from potentially cheaper fuel battling against trade uncertainty.
Exactly. And leads us to, I think, the really critical question for the industry right now. We've got this potential cost saving from lower oil prices, which is great for carriers, but we've also got this deep ongoing uncertainty around trade and tariffs. So will those cost savings just get plowed straight back into, say, aggressive capacity expansion? Or is the tariff uncertainty going to make everyone pause, hold back on big volume decisions until the trade picture gets clearer? That's the real tug-of-war we're watching play out. Where does the balance tip?